that is obvious. In time of market distress or crisis, they can close down the gates and claim they're doing it for the benefit of everybody.
But our index funds don't.
Well, they may not have. Are you telling me that they have documents that say that they will never do it?
You can look back at the trust. So they all have a trust document for all of the.
Making you wait up to Michigan.
Thank you.
So first item is called to order, which I think is pretty easy. Approve of, anybody want to lose approval of the JRIB minutes from the last meeting?
I will make that motion.
Eric Caliper, I'll second the motion. Thank you very much. Next item on the agenda, and we are
A little bit more noise and.
I'm sorry.
It's okay.
In favor, please.
Aye.
Any opposed?
Aye.
We haven't opposed?
No.
Games this late.
Muted.
Aye. All right, better a belated aye than an nay. Okay, so the motion is approved. The next item on the agenda is Milliman. We have a vote on the Milliman report, which affirms the 6.9% discount rate. The presentation has been
A little bit more noise and.
any questions or comments on the report before we take a vote on the report recommendation? By the way, we do have a Millman coming in, Jen's coming in next meeting to give us a presentation, a formal presentation. Any comments or questions on the report? Motion in favor? Motion in favor?
A little bit more noise and.
Make a motion.
Any motion, I'm sorry, yeah.
All right,
Eric, I'll second.
Ken seconds, okay. All right, so now to the meat of this meeting, I think. We're going to have the BlackRock update, and it's not on the agenda, but the strategic asset allocation. Just taking a step back, a group of us were asked to look at the strategic allocation decision, and we've worked with BlackRock along with the expert.
A little bit more noise and.
Barclay, who's there, I see. Barclay, welcome. And BlackRock proposed 5 model portfolios. We looked at the 5 and with Barclay's input, had a consensus decision that 5B was one to be recommended. B Bravo for those of you on the phone. And we're going to at this point turn it over to our friends from BlackRock, and they'll walk us through both the update and as
A little bit more noise and.
lingering question on the liquidity tool that came up at the last meeting.
I just ask you, I don't mind, I'm a little confused about, so you guys had a subcommittee and liked option B. Is that, and it's other?
Yes, well, all the model portfolios will be presented tonight.
Okay.
So that's the recommendation.
No, I saw it in the, I just was confused how we were going to.
Recommendation.
A little bit more noise and.
The NPV were identified by BlackRock as seeming consistent with the interests of the board.
Okay,
Clearly the objectives of the board,
right.
but the interests as well. Then independently, we,
Too, when we had a quorum.
among the 3 of us.
We were waiting.
Got it. Okay.
Yeah,
Isn't that 6:55?
yeah.
Recommendation, exactly. Perfect.
We can unpack that a little bit.
Yeah, look, I'm sorry, I just didn't understand.
I have hard copies if anyone would like it.
Yeah.
Sorry? I have hard copies if anyone would like that.
A little bit more noise and.
Hello to everybody on the screen. Great to see everybody in person.
Thanks for bringing the hard copies.
Of course, I promise we will not go through every slide. I made that commitment to you. But maybe just first and foremost, thank you. Thank you for having us. Thank you to the subcommittee for the time. Thank you for Barclay in advance as well. It's been fun getting to know the JRIB and getting to work on the investment portfolios. So in the interest of time, I think there's 3 things that
A little bit more noise and.
we've accomplished today. And then a couple of optional items if we have time that we can defer to the group if they'd like to cover. First, Josh can give us a brief update on performance. Granted, it's a short period of time that BlackRock's been managing the portfolio, and a bit about the portfolio positioning. Secondly, at the last meeting, there were some questions about the investment vehicles and collective trust funds, which we discussed with the subcommittee, but we'd like to address
A little bit more noise and.
if there's comfort with the rest of the group. And then, as mentioned, we'd like to talk through the strategic asset allocation review and our recommendation. Our hope is that we can make a vote on the direction of travel for that. And then at the next meeting, we could codify that in the IPS. And that will be the bulk of the lifting today. If we have time, we're happy to open the floor to talk about a market update, talk about views on active,
A little bit more noise and
or other topics that are on the group's mind. How's that sound?
Oh, good.
Perfect. Josh, why don't we kick it to you?
So kicking it to the portfolio positioning. So as you're all definitely where we at the last JRIB meeting at the end of June, we had just basically completed the transition. So BlackRock officially took over overseeing the portfolio on June 24th. Was the full transition date. So a little bit more noise and end of June asset allocations. We have the last week of June performance, and we've calculated an estimated June performance that we can give you kind of a full quarter and fiscal year performance just for everyone's just for everyone here. At the next JRIB, we'll begin presenting the official BlackRock performance report. We'll have monthly or quarterly performance depending on the timing of the JRIB monthly quarterly meetings. So this is kind of a little bit more noise and summary of assets. The report will look a little bit similar towards pages 5, 6, and 7. Carolyn has directed, we're going to combine the OPEBs, NAVs, and performance going forward. Today, they are separated by plan. They generally have the same asset allocation, so combining the report should be no problem. The pension asset allocation has been in line about with target. We rebalanced at the end of a little bit more noise and June. So obviously, as we were onboarding, we onboarded into target, and there was not a significant number of days for the actual asset allocation to shift that significantly. In terms of performance for June, the pension portfolio returned about 60 basis points or 0.6% positive for the month, which would bring its fiscal year to date performance to a positive 9.5%. That is off a little bit more noise. And at the end of May, your last Vanguard report had a fiscal year to date performance of 8.8%. So adding on an additional 60 basis points. The OPEB fund had a June performance of about 1.2%. That gets added on to May's fiscal year to date of 11.7 to bring your fiscal year to date performance in the OPEB to 13.2%. Part of the driver, especially in the difference, is the OPEB fund, you can see in the pie charts, it's heavier allocated to equities. Equities have had a really nice run, a little bit more noise. In June month to date, U.S. equities were up about 3%. International equities relatively flat, your non-U.S. equities. International developed was actually down while emerging markets had actually recovered. So if you look at your non-U.S. allocation, there's actually outperformance from EM relative to developed markets. And then on fixed income, rates fell a little bit during the month, even though they ticked back up towards the end of June. There, the ag index returned almost a little bit more noise, and the non-U.S. side returned about 0.75%. So if you add all of that together, combined with the real estate had a little bit of a struggle during the month. Again, gets you to the about 60 basis points for the pension and about 1.2 or so for the OPEB. On a quarter to date basis, sorry, I did not calculate the quarter. I was just looking at markets just in general. A lot of the positive performance, especially in U.S. equity, happened in June. A little bit more noise and bumpy times with really tough inflation prints in April that came out that kind of rocked the equity markets a little bit. We saw drawdowns in April and a little bit into May that recovered very nicely in June, whereas fixed income rates were generally up to slightly flat for the quarter. And so your ag and fixed income assets were very slightly up for the quarter. Again, fiscal year performance, just U.S. equity continues to rip. A little bit more noise and strong earnings season, the tech, the AI movement, U.S. equity up 23% during your fiscal year, where your non-U.S. equity was only up about 11.5%. And then on the fixed income side, again, some small tightening of credit spreads, rates having come down at the end of last year and then ending June kind of relatively flat to the middle of last fall. You're at 2.5% up on the ag and 5.5% up on the non-U.S. bonds. So a little bit more noise in year from other markets for your fiscal year, and with your 6.9% target, I think a really nice outcome for the portfolio, outperforming kind of your expected return.
Thank you. So when we get, I know this is your first month and you're just putting it, will this all be in print on the future? Okay.
In a future meetings, it'll be more standard.
Yeah.
Oh, okay, yeah, as I said, I can't remember.
This is kind of a special hodgepodge
Got
of
it.
topics and
Got it.
materials, but in the future, be more
A
standard.
little bit more noise, and the BlackRock official performance has about a week of performance, so
You guys brought everything over. I mean, you should have all the, you're able to,
we can bring over, we do need monthly returns from either Vanguard or Wilmington. We'll coordinate with Wilmington or Vanguard to get kind of historic returns to pull that all through. But our general practices, our reports show BlackRock as OCIO performance, but for client preference, we can certainly bring back or bring a little bit more noise and.
to the extent possible,
Yeah.
I think we need to, we can't just start day one.
Sure.
Yeah.
Sure. We just need to put the pipes together.
Okay.
That's all.
Okay.
So this will look a little bit different, more standardized, and a little more comprehensive for the next time around. But glad performance is going in the right direction.
Yes. And then 5, 6, and 7 is each fund's asset allocation, the actual dollars allocated within each funds. A little bit more noise, and seeing 2 columns, you'll be able to compare last quarter to this quarter. Then on a fiscal year, we'll be able to do a fiscal year change in asset allocation as well. Again, the private equity portfolio, we received a capital call for the HarborVest 2023 funds. So there's an increase in NAV. We're waiting on HarborVest to send their quarter end statements to us. We'll have official private equity performance. But this just reflects the May, a little bit more noise and plus some capital flow. So the 2023 private equity fund on each of the accounts received a small capital call, is about 500,000 or 600,000 on the pension, and significantly less than that, about 100,000 and 50,000 for the OPEBs. We also received a modest distribution out of the Mesero 6 fund. About 400,000 came in towards the last days of the month. We received that June, I think 26th or 27th. A little bit more noise. And as I said, we'll have a much more complete full performance report. We'll have a whole quarter under our belt as well. That will hopefully have a lot of good exhibits for you all. And if there's anything in particular that you're interested in seeing, we'll roll out that report and we can take feedback on anything that you want to see or would be additive for the group.
I think you said that, Josh, that principal had a rocky period.
A little bit more noise and
You characterize what exactly that was?
so the real estate in general, the fund was down about 70 bips for the month, 0.7% for the month.
Right.
We're waiting on just a call with them. I spoke to them earlier this month. They're very optimistic on your real estate is, been very depressed for now going on a couple of years. They see some opportunities, but they're still holding some assets that are depreciating with rates rising a little bit. That was a little bit more noise on overall valuations. They haven't been doing much in turning the portfolio, so there's not a lot of acquisitions or turnover in the portfolio. This is more just driven by kind of signposting valuations, and as rates came up a little bit towards the end of the month, they posted a bit of a negative return.
Just as a note, when they presented to us, they made a persuasive case that they were not in CBD offices or areas that would
A little bit more noise and
serious issues these days. If anything has changed or anything strikes you in that vein, it'd be interesting to hear. I had the impression that, warehouses, regional offices, a lot of medical type facilities.
Yeah, they're definitely positioning the portfolio a little bit opportunistically. It's a core plus strategy, so they can make that a little bit more opportunistic. I would say a month return is a little bit more noise and more market general related. I would look at their performance over a whole year.
Sorry to interrupt, but you have a pair of fresh eyes.
Yeah.
It might be useful. I'm not reflecting on the month, I'm reflecting more on what we know is going on in real estate and the fact that you have fresh eyes on this.
Yeah, I mean, their approach is similar to what we see with a few other core U.S. core real estate managers. They're very focused on kind of the industrial warehousing end of the market. That seems to be have a lot more opportunity for NOIs to improve and for the fundamentals to look a little bit more attractive. Like all core managers are trying to exit the office space. They're not offloading. They do have a queue for exits from the fund. the fund itself is maybe 7 or 8 billion. They've got 300 million in redemptions that they fully expect to be able to redeem. They have a rule on the fund that they're not going to redeem if it causes them to sell assets. So they don't want to lock in losses, but they have the available liquidity to go about doing that. And again, they're just looking opportunistically. It didn't sound in the last quarter that they gave us an update that they were making significant, acquisitions or dispositions of properties, but they do have a very positive outlook on kind of the industrial and the residential market, especially as rents start to get repriced. It's been one of the drags on inflation, obviously, right, as we're waiting for leases to come up and come due and the repricing that happens there. So they're, kind of the way that they're thinking about the market there, that they think that there's some upswing opportunity. They're also, as part of their opportunistic part, starting to shift into, areas of core real estate that aren't as prominent in the index, like data centers and things like that. You see a lot heavier weight in listed real estate markets that have swung a lot more towards your data centers and cell towers and things like that.
Is it a fund of funds underneath, or are they actually buying them?
They are buying the properties themselves, which are fund. Yeah.
And at some point, they'd probably go back into commercial, because as banks start loading it, as the opportunity piece.
Exactly. And again, they think that they have some dry powder that they're able to eventually deploy. I mean, that is one of the cases I think people make for real estate right now, is that there's mispriced assets sold off, people in bad loans that need to get out from their property. And if you're in a good position, you may be able to acquire things at lower costs. So they're monitoring the market. BlackRock's real estate team has a similar outlook to Principal as well. And, sees the near term as an opportunity, but, as long as rates stay high, Fed isn't aggressively cutting, it's going to be a tough go for real estate.
What it's worth, Carolyn reports to the Board of Finance, which, will ask inevitably tough questions about stuff, and real estate would be a topic that would be top of mind,
Yeah, of course.
obvious reasons.
Yeah. If you need any, there's any very tough questions, again, through Danny and myself, we can access BlackRock real estate PMs to answer questions as they see them.
That would be helpful. That would be helpful. Tom's being gentle when he says they ask tough questions.
Yeah, they'll get even more granular on regional, there's the, do you prefer this, the way that they break up in real estate, it's kind of quadrants. Even though the north is pretty heavily northeast, but it's north, and the south is also pretty heavily southeast. But, the real estate team will have, a view of like where there's opportunities. Is it regional? Is it sector?
Be a good special topic for us to bring. We'll note that down.
No, I think it's prudent and prescient.
Any other thoughts or comments on performance positioning before we shift to collective funds? So there's some materials in here. Josh did a great job of putting together some content. Josh, do you want to maybe 2 minutes on collective funds? If you have any comments from our conversations as well, but we just want to make sure we address the questions from last time.
Yeah, and if there's very, very specific.
Slide 9.
Very specific questions. We do have a collective trust fund team at BlackRock who help with some of this material, but I can bring some questions back. They had some conflicts with dialing into a call, but I can certainly connect with them. We work very closely with them and the legal team over there as well. In terms of, the collective trust fund, again, the index funds in the pension are invested in what we call collective trust funds. It's a vehicle, as noted in the title. They've been around for 100 years. They're generally sponsored by asset managers and trust companies. And they're really they're really investment vehicles specifically for retirement plans only. That's generally who invests in it. They're investors who share a very similar long term. So there's not day trading of collective trust funds. They tend to be very long-term thinking investors, though the funds are daily liquid. And we did discuss this again with Nick. There is that notification period. We can talk a little bit about the liquidity of these funds, but they are liquid index funds that you're invested in. They trade daily. Cash is raised on a daily basis out of these investment vehicles, and they're very similar to mutual funds, other than maybe this notification period. They pool investments. The idea is that you're collecting a pool of investors to get economies of scale. One of the big differences between mutual funds and collective funds is you have bargaining power with a collective fund. Mutual fund, there are share classes, but you can't negotiate the fee. We actually can negotiate the CTF fees.
Maybe I'm a little confused. Are we in these funds now, or are we at Vanguard, we weren't in these funds, were we?
No, so Vanguard, their approach is to use some of their mutual funds. They have share classes.
So you, within the public market portfolios, you're in pooled vehicles, similar approach.
No, but back up. I apologize. I'm a little confused here.
Oh, yeah.
When we transferred from Vanguard to BlackRock, did you guys switch us from ETFs to this without our approval? I'm a little confused. I don't get it.
We switched to the BlackRock equivalent, and our proposal was using the collective vehicles for that versus.
Haven't we raised a million questions about that? Very concerned about it. The whole purpose, I thought, was to, I mean, we can go forward from here. I'm sorry, I'm just
Yeah.
confused.
No, our initial proposal, when we pitched for the business, was that the pension would be invested in BlackRock's collective trust vehicles. We have, oh, yeah. Into, our collective trust business, it's $1 trillion. We have
No, I understand, but,
dozens of, yeah.
okay, go ahead. Well,
So similar investment approach, but yes, they're in the,
I know,
they're different.
but they're not. And this is a real concern. I don't know if I'm the only person here who has that concern. I know Nick did.
Hey, so I'll chime
Sorry?
in. Sorry.
Oh, okay. Yeah, Nick.
Coming in remotely, I would say, yes, I mean, I recall the business being pitched with the collective trust funds as the vehicle. And what I wanted clarity on was the use of daily liquid. And there is just a bit of timing differential in you need to give a day or two notice period for the order to be placed. And then the order to be, once it's traded, everything settles T+1. That was the question that I had. But I think we've known all along that we would be investing through the CTF.
Oh, okay. When you say invest, I mean, it's not like we don't have the option to use what we want, I hope. And maybe I'm just confused. I mean,
Yeah,
mea culpa.
would it be able to take a step back on
Yeah.
why we're using collective funds and
Yeah.
why within that approach and the trade-offs? I mean,
Sure.
that's part of the intent as well today, to understand the.
No, I understand. I mean, to me, not to interrupt you guys, but I appreciate what you gave us. And it's basically, I could have gotten this from Wikipedia. Let's just say for the sake of argument that they're half of, but it's six of one, half a dozen other versus ETF, SPY, SPY, or whatever the cheapest ones are. But they're not daily liquidity by definition, because we have to put in some sort of notification 48 hours ahead of time. And the reason they do that is obvious. In time of market distress or crisis, they can close down the gates and claim they're doing it for the benefit of everybody.
Our index funds don't.
Well, they may not have. Are you telling me that they have documents that say that they would never do it?
You can look back at the trust. So they all have a trust document for all of the.
But the whole reason that not the whole reason. The three reasons that we spent a lot of time and then decided to go to a passive strategy for the majority of our liquid, stuff was obviously cost and liquidity are the two overwhelming. We did it. And, look, I'd say 99.44% of the time, we're not looking to be forget day traders. We're not looking to be traders here.
Sure.
But it could be a time when there's a market, like during COVID, when things went cuckoo, we might decide to make some sort of strategic change that we don't want to wait 48 plus whatever hours to the market's.
You notice, so that is different.
They did that, right, during those times. And unless you're telling me that, we're saving gigantic amounts of money, I just don't see them. I mean, there are index funds out there that charge 1 or 2 basis points, right? So how much cheaper can you get, and what does it matter? ETFs. I just don't understand, other than you guys want the business at BlackRock, which is not.
So if I'm hearing you correctly, cost is the the freight notice. So that is different.
Cost of liquidity,
So cost and liquidity,
performance.
and being passive, of course.
Yeah.
They're all passive strategies.
No, I-
Implementation still passive. From a cost perspective, that's the major benefit of the collective funds. They can be, and I think Josh was going to walk through, there is significant cost savings to them. There is a trade-off to that. As you mentioned, is the liquidity. They trade on a daily basis, but you do need to give the 1 or 2 day notice. So that is different.
Can I just say one
You
thing?
can't make that move.
Can I just say one thing? You just can't say something's daily liquidity and you have to give it a 2-day notice.
We're
I'm just saying,
we're not
it's a
saying
bad
it's
thing. I'm just saying from a marketing point of view, it's a really awful thing to say. It's just not true. It's like saying something's blue that's green.
Sure.
It's just
They
not.
trade with 1 or 2 days notice.
Okay.
They traded 1 or 2 days notice. That is the trade-off. The
Well, it's a
trade-off.
huge trade-off. I can't imagine, how much can we save? There are ETFs that charge like 1 basis point in the marketplace or 2. I see that, is this free? What is the,
So on the next page, we compared the ETF version of the funds and the CTF versions. of the funds. So on your total stock market, there's a 2 basis point difference. On the non-US equity, that's a 3 basis point difference. I think that on the ag side, the cost is neutral there between the ETF and the collective fund, and then on the non-fixing. So the index collective funds do have 1 to 3 basis point difference.
is that, I see that's the difference between the 2 funds you chose. Are those is the ETF you chose in every case? Not necessarily the one you guys offer at BlackRock. Is that the cheapest one in the marketplace that has decent volume and size? Or is that just the one you guys chose? In other words, you have 1 versus 3, 4 versus 7, 3 versus 3, 6 versus 7. So the greens are the higher.
Yeah.
Are those the absolute rock bottom lowest fee ETFs in the marketplace, or are they just the ones you guys chose to make? And number 2,
These are the lowest fee ETFs at BlackRock,
at BlackRock. Well, I hope we're not
And
limited
they're-
to BlackRock.
and they're about the same. We did a comparison to the Vanguard fund fees, and they're basically the same
Yeah.
fee that you were paying to Vanguard from a product fee perspective. Actually, I think our product fee comes in about 0.5 basis point lower than what Vanguard was charging. for
Yeah.
the Product fee.
And as far as the initial portfolio, our direction was to map over the exposure
And number 2,
of Vanguard.
I'm not.
To that point, though, as part of the strategic asset allocation, if you'd like to shift the allocation, if you'd like to talk through vehicles, that's what part of these discussions are for.
Sure, and this is just my opinion. I don't mean, I don't want to monopolize this.
Sure.
I would just finish and then open the floor that personally, I'm pretty sure that there are cheaper versions out there than these, number 1. These just happen to be the BlackRock versions, but they won't be much cheaper. I mean, it might be 3 versus 2. And number 2, I wouldn't even think twice saving anywhere from 0 to 1 or 2 basis points and giving up the liquidity. And again, I would want a letter from BlackRock saying that there is no chance a gate could come down under any circumstance. I'm talking about any circumstance, hail, wind, God, Moses, tablets, anything. Because the only reason to do this is to be able to, not the only reason, one of the major reasons is that it gives us the flexibility to move in and out when we might need to,
Completely agree.
which only is
Spiders,
a very, very blue moon, if ever.
Sure. Completely agree.
I had a question that's in this vein roughly. And I don't recall the IMA, maybe the question's answered in there, but Josh, you're OCIO. I assume you have fiduciary responsibility to find us the best deal. So to Ken's point, if hypothetically S&P spiders are a cheaper execution than an iShares equivalent, wouldn't you have to pick under fiduciary?
So in the IMA, it has selected BlackRock to be the index manager.
Okay. Like I said, I might have to review the
We
IMA.
signed on to a contract that limits us to 1 provider of index funds?
I think part of the pitch that we had is BlackRock is your index provider as part of the OCIO relationship and relationship mandate.
Yes.
Beyond the index investments, we're not limited to BlackRock. Should you choose to incorporate other approaches in public private markets, you are not limited to just BlackRock, to be clear.
To what Tom's saying, I'm actually a little surprised because BlackRock is terrific. We chose you for a reason. So this is not in any way anti-BlackRock. And you guys have generally aggressive fees. But as a fiduciary, if, I mean, I know Fidelity, for example, of this fund for free. I don't know if it's for institutions. It might just be for individuals. Free, zero. They're not charities. They make money other ways. They lend securities, whatever they do. It's not my problem. But so you're saying that you can be a fiduciary and put us in a BlackRock fund that charges more than an equivalent fund and not violate the fiduciary obligation? And maybe Barclay, I'm sorry, Barclay might have an opinion or knowledge about this.
Well, first of all, part of the BlackRock proposal was a max fee for all passive assets, correct?
Was said max fee?
We have a 5 basis point fee contractually from you guys on all passive assets.
The negotiated product fees.
Yeah, 5 is the OCIO fee. The negotiated product fee is 2.5.
Yeah, that's right.
Yep.
So that's our max fee
Yes.
is 2.5. Now, if you take a look at the Vanguard funds, which included some non-US indices, it was higher than that. So this was a good deal. Secondly, and I think it's Ken that's asking all the questions, that was one of the cons with BlackRock, that oftentimes they use their own product. I don't see it as a con, however, when it comes to index product. I do have one question about the CTFs. If they're liquid, the way I interpreted it was, if it's daily liquid, but we need 2 days advance notice, when we give you the notice, the valuation is frozen for us, and then we don't get the funds for 2 days. Is that correct?
No, the funds trade on the trade date, and that's when you execute the trade.
Yeah,
And if
maybe
we-
just a level set on the framing. They don't, from a client perspective, they don't trade daily. When we say they trade daily, our intent was they're not gated. There's not quarterly redemptions. But BlackRock traders are moving funds in and out on a daily basis. For the purposes of Fairfield, they have 1 or 2 day trade notice. That's what you need to give to trade out of it, which is different than a mutual fund or an ETF.
So if
just
we were
mix
to
the
say,
trading
if
daily.
we were to say noon today that we wanted to liquidate, you would probably trade on Friday, and that would be the price we would get?
It would probably be Friday. There's a chance with some of the funds we could short notice, but I wouldn't promise we could short notice, but there's a chance with some, especially the
You know,
large.
my
liquid index
point
funds.
is, we
But,
don't
yeah.
get the price on the day that
Today.
we notify. We get the price
Correct.
when it's traded, which is some point in the future.
Correct.
Okay.
I'm gonna hold off and see if anybody else has anything they'd like to say.
Carolyn, I don't know if you're able to weigh in. I know you're in a car.
Me?
Yes.
I'm trying to follow along here.
It's
I
tough in the
don't
car.
like the lack of liquidity. I don't know if you can hear me. I'm not a fan of that
We hear you.
lack of having to wait. Only because, well, 99.9% of the time things work fine, and that shouldn't ever be an issue. It's that moment when everyone wants to move at the same time because we have to do something that I don't want to have to wait in a queue for. And so I think Ken's concern is spot on. I think Barclay's identifying an issue for us. He's rightly tactically laying out something that we've actually lived through on this board before, that we'd really like not to go through again. And you know, I think we're kind of learning as we go here, but I think these are probably not a great option for us. Just on the basis of the points that have been highlighted. And understanding that we did negotiate kind of a max fee exposure on the passives, and so let's work within things that have the daily liquidity, and and fit within the construct of our max fee.
Does our agreement with you guys say that we have to use the collective investment trust versus the ETF that we're comfortable with, that we had before?
So
I mean, it's like, sounds like North Korea.
So in having BlackRock as the index provider and within the construct of the contract, and this is going to start to get towards like a legal side, we've signed up as an ERISA fiduciary. And one of the other reasons we use collective funds is because we can negotiate that fee and charge you that single 2.5 basis points fee. We cannot do that with a mutual fund. And we have to work backwards within an ETF construct of rebating fees to use an ETF. It's a more complicated process and
Talk English. I don't know.
the ERISA fiduciary standards give us the allowance to use the collective trust funds as our index fund basis for our pension clients, for clients that ask us.
Although, you know, although we don't run ERISA money, right? You know,
Not ERISA.
we're not ERISA.
You're not ERISA. You've asked us within the construct of our contract to serve as an ERISA, a fiduciary up to ERISA standards. And that is higher standard.
Up to
That is the
ERISA
higher standard. That is the
right,
ERISA standard. Without the ERISA standard.
Right, but from a, right, but there's something between, you know, ERISA style of governance versus the, you know, we're not ERISA money, right?
I just don't, I'm sorry,
So-
I don't understand. So I'm looking here, Fidelity, FX, AIX, just randomly pick this, is a S&P 500 fund. Its fee is 1.5 basis points. So give or take, I mean, nobody's getting lower than that, 1 basis point, whatever.
So ours would be a half basis point cheaper.
Half basis point
Cheaper
cheaper.
than that.
But this board has to have the ability to say, well, for half a basis point, we'd like to have a fund that we can truly, I mean, this is 60 or 70% of our fund's assets when you combine all the passive, right? I don't know what the number is, but you know, the different classes of passive. I mean, this is, this is serious. We have to
So-
resolve this. I mean,
So look, I'm glad you're bring that up.
and just one other thing, you said yes. I don't think you guys would give us a letter saying that there's no circumstance whatsoever that we could be gated and not be able to trade. Right? There's no way you guys are.
I don't, I'm not.
There's no way you do.
Yeah,
Not a chance. The whole reason that this is done, and I understand why, is to quote, theoretically protect the overall pool. Right? If everybody's panicking and trying to sell, this is a way to slow things down and so forth and so on. But that's not what we're worried about. That's not our interest. Our interest is the town of Fairfield's pension fund.
Sure.
And we may, I'm just picking something, we may have some crisis in our, you know, our alternatives that require us for some reason to make a decision that we simply have to sell X% of the passives that day.
I think you're bringing up fair questions, concerns and considerations of which I wish we had better answers for you today.
No, I hear you. And I'm sorry for not, I mean, I was on the committee that made this selection and I'm still thrilled with the choice, but I just don't remember this being.
Sure.
I didn't focus on it.
I guess, Arjun, we don't want to appear disingenuous. Our proposal was for BlackRock as the index manager using the collective funds. Because of costs and all those reasons. If you as a group decide that there's concern using those vehicles, you'd like a different approach, we'd be happy to take that offline and open that up. But we'd have to talk through, do you still want us to manage with an ERISA standard? Do you based off of our proposal, do you want to alter that? We have capabilities to do whatever you
We're
want.
talking about passive ETFs that track big market indexes like the 3000 and the S&P. And I mean, there's a lot of words being thrown around. There's no way that anybody would consider us to be somehow reducing our standard of care for the Fairfield Pension Fund by going away from a
No, I think with
instrument that has a gate, I'm using a colloquial word, gates, versus a, you know, $600 trillion index fund. I mean, that's run by maybe by iShares, for example,
sure.
or Vanguard or Fidelity.
I think the ERISA, and I'm certainly not an ERISA expert, so I don't want to go down that road, and I'm sure you don't either, Josh, but I think Josh's point was the collective funds allow us to make this the competitive option from a price perspective, which we can't do with an ETF. But we could incorporate ETFs. Am I wrong if that's the approach we'd like to take?
We can definitely look.
So hold on, can I, guys, let's just stop there. let's just full stop there. Okay. If you want, we can go fully back to all of the documents, everything we signed up, everything you pitched, all the notes we took, and we can go point by point by point by point. And I would really hope that that's not necessary here. I do not want this group to go down that path. How about we just take a step back, take a deep breath, and realize that, okay, there are some points of consideration that we have to think about, right? We're gonna step forward, we're gonna take back, we're gonna learn, and then we're gonna iterate again, right? I don't feel a pressing need to solve this right here, right now in this call. But I think we have some homework ahead of us, and I would really appreciate a thoughtful and a fulsome, quiet, thoughtful discussion around it and what all of the options might be. And it's very clear we need to pull Ken into this and Barclay, whoever else would like to be in there. It's also clear I think you guys need to kind of circle back too. So we're not going to solve anything here on this. So I'd really like to kind of move forward if we can. And you know, in the interest of time and just in the interest of good relations.
Agreed, Carolyn, and I was gonna literally say that before you started saying it, because I agree with you, we're not gonna resolve this tonight, but I also don't think this should be this needs to be addressed and, you know, ASAP. If we have to have a small committee, that,
More than
you know what I'm saying, I don't want to wait till quarterly meetings and stuff like that, because one of the things I've learned from a career in the markets is that it's very easy to always say, well, it won't happen tomorrow, it won't happen next week. Well, the truth is, the disaster will happen tomorrow. It just doesn't, we don't know when tomorrow is, but, right.
We are committed to being transparent, to walking through this. We understand these new terms, different approaches. We more than happy to spend as much time as needed to do that. Without doubt.
Okay.
I'm for moving ahead too, but let me make 2 points as you do your homework on this, which we file away. One is that it's hard to envision an environment where you would make a major change in a policy allocation to U.S. equity or global equity. You know, when there's been a big bad day in the market, when people panic out, it tends to be the wrong thing to do. So I would be shocked if any market move would cause us to move away from our target, particularly given the communication from your committee that you were so policy-based and didn't want to be tactical. Secondly,
Hey, Barclay, before you go to the second point, if I could just drill down on what you just said. There are people on this board who have been on the board far longer than I have. Have we ever done that? Have we ever tried to move on a dime?
It's a while ago, but yes.
Yes.
During the 0809.
0809.
Yep.
All right.
and
Yes, and during COVID, and March of 2020, to move on a dime as well.
the second point is that when you use the word gated, it has a number of meanings. When you're in a hedge fund and you get gated, that can be a year or 2 years. When you're in a index fund, regardless of the vehicle, being gated does not mean a long period of time. It probably means 4 days, max.
It's not acceptable.
Well, if something bad happens and Josh says, as our OCIO, oh, I think Fairfield should be out of something, and the rest of BlackRock moves quickly because they have ETF liquidity, then Josh is unable to execute on our behalf quickly. Hypothetically, that's the reason I asked if this has ever happened to us before. But you could be a BlackRock employee where you're constrained to not act because you're in a certain type of instrument versus your colleagues who can act.
I see what you mean there. I'm making a decision not to act. This was, I'm trying to act.
You're trying to act on our
Oh,
behalf, and you're unable to act on our behalf. The guy sitting next to you, who's an OCIO for an organization that's made a different decision, that is ETFs, he or she's able to act quickly, where you're hamstrung.
I will add one element. The AUMs in these CTFs, they're all retirement plans. BlackRock's pensions OCIO business predominantly uses the collective trust fund structure at BlackRock. We tend not to use ETFs outside of some tactical decisions where clients have given us tactical abilities, but we predominantly use the collective trust fund. So all of our client base, we're making and doing the same, well, not necessarily the same movements. It's one thing for a client and not for another client. But if we're trying to trade across our book, we're trying to trade all of our collective funds.
Can I ask a question? How does BlackRock benefit from the 2-day lag? And said, it slows us down from exiting, but what else and how does slowing us down benefit BlackRock?
No, the notification period is pretty standard across all collective trust fund providers. These are common across almost every single asset manager and bank uses some form of these. It's
How
more
does it benefit them? What's the economic advantage?
I think it's more of their using the notification period as a way to line up their trades. One of the things collective trust funds allow is cross trading within the fund. So if someone's buying and someone's selling, they're not going out and selling all the securities and then going out and buying all the securities again. They can just swap the units that you own of the trust itself between beneficial owners, between pension plans. So if pension plan A is saying, I want to sell $100 of the Russell 3000 fund and another pension plan wants to go buy it, they're not going to sell $100 of US equities and then go buy $100 of US equities. They keep the equities within the fund and then just swap the units. So one of the big benefits of that notification period is they can line up cross trading across clients that are trying to enter and exit the fund.
Well, I think Carolyn's point is well taken, which is that I think we've expressed, that's a great question, by the way. I mean, that we're really concerned. It's a overwhelming percentage of our portfolio. So one way or another, we have to come to comfort with this, right? And we might come to it. I'm perfectly.
Look,
I'm sorry, but I'm just gonna say that I guess what we'd like to really drill down on is how hard and fast this notice period is and under what circumstances it can be extended. Even as Barclay says, I agree with Barclay, by the way, it's hard to imagine a fund like this, stretching out for weeks or months. It seems almost impossible. And then again, what happened in 2020 when oil went to negative, whatever, $50 a barrel, seemed impossible too. So weird things happen, as we know, in financial markets. But getting back to us with those pieces of information, and then we can go forward from there.
we can definitely re-engage to make sure that we thoroughly rolled up our sleeves on the topic. And I'll just, before we move on to the next step, I'll acknowledge there's different vehicles and approaches, and there's pros and cons to both. We want to find what best fits for you. So we'll make sure that we do that when we land in the right place. So
As
please
you
continue
roll
to ask
up,
the questions.
as you roll up your sleeves on that, figure out if we required you to use ETFs, what that would do to our OCIO fee.
That seems like a key question.
Perfect.
Like you said, you negotiate for the group, whoever's in the CTF, you're negotiating. Who's on the other side? It's you guys, another part of your business. Because it's your fund, right? It's not like this is a different company's CTF or you as the OCIO. So we're negotiating. You negotiate against another part of the business, right? Is that how I interpret it?
Separate legal entities.
Yeah.
Within the overall.
They are
Parent.
ultimately BlackRock subsidiary.
It's what allowed us for a discount to it in our proposal. They're under the BlackRock umbrella. Yeah.
Well, somehow or another, it doesn't take a genius to see that this is more lucrative for BlackRock than a regular ETF. It has to be, that's a fact. Question is why, and what does it mean for us? Right? Or else the company wouldn't be offering us an aggressive OCIO fee if we do this. So there's a reason why they want, the aggressive OCIO negotiated fee. It required us to be in these vehicles.
I might separate, please, keep me honest. I might separate the OCIO, the advisory fee versus the product fee.
No, I know that, but
we'd be thrilled to manage Fairfield's money in different vehicles and we offer the ETFs, we offer mutual funds as well. The fees are just higher on it.
on the products.
On the products, that's also the product.
Barclay was implying that we chose to use use a regular ETF versus whatever this thing, the collective, the CIT.
Yep.
That might affect the OCO fee that we negotiated
Not
with
the
you.
OCI fee, the product.
No, without question. Yeah, no.
I just wanted to know how it affected the all-in fee. I mean, I found 2.5 basis points for the product fee to be very attractive. It's less than you had at Vanguard. And recognize also that Vanguard was making a profit on the funds. It's a small one, but they were making a profit because they were using their own products as well. But the 2.5 basis points is a pretty darn attractive fee as we spread across passive asset categories.
We can walk through the numbers in the spirit of moving on.
Yep. I'm all,
The product fee, that.
I got it. Yeah.
We'll discuss that the next meeting or in between now and the next
I think in
meeting.
between, we should discuss. So we can huddle up on the best time to approach it.
When the evening ends, we'll sort it out.
Perfect. Moving on to the next topic.
No problem.
Jess, do you want to frame the strategic asset allocation? Comments up front that we spent some time with the investment subcommittee. But our hope is to walk through our recommendations and hopefully get to a vote so that we can move forward and begin implementing that.
Yep, and again, thanks to Tom, Eric, I see Nick on the phone, and Barclay also for the collaboration here. On page 12, we'll focus today on the left-hand side, the SAA options. I think in the interest of time, we'll hold off on active, passive, and the IPS guidelines, but ultimately a decision on an SAA option will eventually be captured in your investment policy statement, as well as BlackRock's investment guidelines. We manage to the asset allocation that the committee approved, and we codify that in our guidelines as well as in your IPS. We hope that we can have the IPS, approval today on an SAA option with the IPS and our guidelines to be brought at the October JRIB for approval at that point, where we would potentially transition, if decided, asset allocation after that period. So we'll focus on the SAA options. I know we have here active, passive potentially today. I think we'll table that for today. But just recognize the subcommittee, Barclay and BlackRock, we've talked about the idea. I know that the committee all has their own ideas on what their preference would be, and we can maybe get to that at a later date. In terms of just an executive summary, lots of text. I know when I sent it through, I did it, but the idea was first confirm your broad return goals and the needs and what is the investment objective overall. You're trying to meet and attain the actuarially determined return. What we found with the current asset allocation, the current asset allocation does support it. I think Milliman sent the report today that the current asset allocation does support that discount rate. So in the need of trying to support discount rate, there's no necessary need to change the portfolio. But we think that there's maybe a little bit more efficient way, a little bit more diversification that can help bring down some of the risk overall in the portfolios. One of the impacts of volatility of your portfolio is the amortization, and that leads into, if you underperform the goal, leads into higher potential future contributions. So you want to try and that return as much as you can, exceed that return if you can, for sure. And so again, at a high level, keeping the current asset class taxonomy, that's just public equities, US and non-US equities, as well as US and non-US or aggregate bonds. There'd be a slight change. That is portfolio A for the pension plan on page 15 and portfolio A for the OPEB plans on page 19. It's just a slight reweighting, especially in the fixed income side, out of a little bit of the non-US more into the US aggregate bond side. But again, you're going to achieve very similar risk and return to your current portfolio. We don't think if that was the ultimate goal to add no new asset classes that you probably wouldn't change the portfolio at all. BlackRock does believe in diversification. We think that there's value to have a bit more granular asset classes, what we call sub-investment grade asset, fixed income in particular, adding high yield and emerging market debt. They provide differentiated sources of return from geographic regions, issuer credit ratings that do provide attractive yields and attractive returns, and can help diversify the portfolio we have prepared portfolio B, which is the primary recommendation from BlackRock and from the agreed upon recommendation from the subcommittee. What that does is you can keep your expected return. There's no need to change your discount rate. And again, in meetings that we had with the actuary and in some analysis that we've done, you don't need to shoot for the moon in terms of return. That 6.9% return is a very comfortable return to meet the needs of the plan. And so there's not a need to re-risk or increase risk in the plan to shoot for a higher return. And the same thing goes for the OPEB. The OPEB is already on a slightly riskier allocation pension portfolio because it's underfunded, and you're looking to help improve that funded status on the OPEBs. But we don't think that you need to take more risk. What we can do by diversifying asset classes is have the same return and reduce the overall portfolio volatility, which should help protect a little bit more protection if there's a more down year in the market. You're not going to capture as much downside as the current portfolio, and help you kind of steadier that journey to fully funded and remove some of the volatility around the contributions. It's about a 50 to 100 basis point reduction in risk, which we think is a meaningful enough amount to change the portfolio. And so maybe I'll pause there because I think I maybe hear a question.
Yeah, guys, sorry, you probably hear the road. Can I ask a question? So by changing the real estate allocation in your option A, does that mean you're effectively suggesting that we should redeem our real estate private equity fund, which might prove to be very challenging, as you had mentioned in a previous conversation this evening?
So we do believe that from an asset allocation perspective, you can get the diversification benefits and the income and return from using more public market fixed incomes. There's a fee savings. The real estate fund is 80 or 90 basis points. But that wasn't my question. Yeah, sorry, that just wasn't my question. Are you telling us you want me to redeem the principal real estate fund? That is the recommendation based on the strategic allocation. With a zero allocation would be a redemption.
And you've also mentioned that fund has made it very redeem because they have a policy in place whereby they won't entertain redemptions because they won't sell down positions at a loss, right? And so they already have $300 million in redemptions ready to go. So we have to wait.
No,
so
they
how long do you think that happens?
No, they confirmed that they would be able to fulfill redemptions this year. That they're not in a position where they're going to be unable to redeem the assets.
And what kind of valuation on the redemption?
But you're getting for the NAV that you have in the portfolio today.
Why would you do that now? Rates are projected to come down next year. Might be a cut or two this year. We'll see. There might be more inflation next year, geopolitical stuff. Inflation Reduction Act is a tremendous amount of U.S. government spending into our country. We got nearshoring occurring. Real assets, real estate should benefit from higher pricing over the long term. As a diversifier, having remaining in the real estate, it's a small piece, 5%. We have a lot of liquidity in the other stuff, regardless of 1 or 2 days. It's the issue, but primarily we're very liquid. Stuff. I say I agree. Another diversifier is the infrastructure is another piece, and then as a board, I thought, did we do 15%? Were we at that target for private equity at one point? They're up. Then we're targeting that. Then there was the markets shifted, and all of a sudden the denominator effect might have gotten us.
I mean,
I think we should be obviously adding more pieces, getting that diversity, not exiting stuff because we want, everything should be uncorrelated. Some of this stuff is uncorrelated. Yeah, real estate might be outperforming as well right now. So it's going to be a recovery in certain sectors.
So what would be the rationale for getting rid of the 5% real estate? What's BlackRock's OCIO advice for that reason?
So
Counter what he's saying.
Yeah, so there's two elements. So one is you're drawing income. A portion of the real estate fund is providing income generation. There's a lot more attractive areas for income in public fixed income markets today. So you'd be able to replace and exceed some of that income that you're getting from the updated asset allocation, introducing other fixed income type assets. From an inflation protection perspective, the listed real assets certainly provide their long date. The valuations tend to be based on long dated cash flows that are able to be updated for inflation. That's, you're looking at things like utilities and things with long dated and they can pass costs on. We've also seen the ability for equities to pass. We've been able to adopt some of the inflation pass through on the equity side. Being able to maintain, being able to adjust some of the risk profile of the portfolio to reduce the portfolio volatility. We don't want to be we're not trying to be tactical around the real estate allocation and waiting for a market turn or waiting for a recovery to come. We expect rates to stay higher. So we also don't expect there to be as significant maybe of a recovery in some of the real estate area of the market. But again, we're trying not to be tactical on a decision and waiting.
So my recommendation here would be that in the October meeting, we have a very busy October meeting and we invite principal to present to us so that they can have an opportunity to talk to us about their fund and we can ask the types of questions that would be warranted, right? Because understanding we're in a cycle and we might be at the trough of the cycle, but we knew we're going into this part of the cycle. And as Eric rightly points out, these are highly uncorrelated to the rest of the portfolio at this point. So I don't know if anyone else has any thought on that, but I would like to hear a little bit, have principal come back. And then we can have an opportunity to weigh the one against the other.
The only thought that I have that actually supports BlackRock or committee's thoughts would be that, and I don't know enough about the principal fund, its underlying holdings and the lag, but a good chance that the true reduction in real estate values has not been captured in the pricing of that fund. And that if in fact, which I think there will be substantial interest rate cuts, I think bonds will dramatically, I think, outperform real estate in a 1 to 3 year period. But we don't run a fund for a 1 to 3 year period. So I'm contradicting myself. So I think the real issue is what Carolyn was saying, is that we probably need as a group, or at least I should speak for myself, to better understand what principals' holdings are and how they've been affected up till now. Because I've read a lot on, not my area of expertise, but I've read a lot of good articles that say that there's a lot of real pain coming, mostly because most of these funds simply haven't properly accounted for the true reduction in value. I mean, there are buildings that traded for $800 million 10 years ago that I think one traded for like 19 million, some crazy in New York, some trophy building traded for almost nothing. And it was valued, like $1 billion a couple of years ago.
I just wanted to address Eric's point. If you, Eric, if you read back on slide 36, the assets that are in the listed infrastructure portfolio are actually pretty share characteristics with a lot of the stuff, I would think. Now it's 3.5% versus 5%, but we're also adding EM debt, and we're also adding high yield in option B if we proceed with that. So I think your correlation comment is pretty well addressed. And these are listed assets, so they're more liquid and the fees are lower. Well, so and finally, if you look at the capital markets forecast, long-term capital markets forecast for BlackRock, at least they're putting their stamp on.
Here's a principle, a year from now, if your real estate group comes in, here's a recommendation, why don't you go into BlackRock Real Estate? And we're just talking about, lack of concentration of the funds, of who owns it, really, who's managing it, right? So here's an outside third party that's managing part of our portfolio. While the rest of the ETFs is going to probably be staying with the majority of the stuff is BlackRock. We have some diversified managers because they're not being managed by BlackRock. And going back to our previous relationship, I came on, my first meeting was, we went out everything, and into Vanguard products. And this is obviously the same thing. So going to be BlackRock products, BlackRock strategies.
Generally, when we propose active strategies, they're going to be third party. And you would have to select, if we were to bring BlackRock, you would have to select BlackRock. It would be entirely in your control, not something that we would put into your portfolio. But I'll put that out there right there. We have a broad platform that has many managers, many third-party managers on it that we select from and that we would operate from. I don't anticipate that the real estate allocation, we would be tactically shifting back in. So if it was a decision to be made, we would not necessarily re-enter. But obviously I can't promise that.
Have good
From our,
your BlackRock people, your real estate fees, so nothing against, but, at the same time, you're going to.
It's difficult to separate Josh, the recommendation isn't a commentary on principle.
Right.
Just views on the asset class versus other asset classes long term. I think a next phase in future, not for now.
Right.
If you wanted other active manager components, that's a separate piece, but it's hard to separate the two as we're putting this together. But the recommendation as an option to move from real estate has the other implications because it's adding the high yield, it's adding the emerging market debt. If you keep the real estate, for example, you'd have to rethink about the equity weighting. So it's the whole portfolio that we're trying to think through versus just the piece. Is that fair to say?
Yeah, and it's not a commentary on principle and their management in the fund. I mean, real estate's been a difficult asset class.
When assets are down, that's when you want to be buying. You don't want to be exiting. And we're looking at a very long-term duration. If it was 50% of portfolio was real estate, I say absolutely reduce that 5%. We have a lot of other stuff and there's room to add to these other things.
Part of the problem is that you guys just took over and we talked about that at the beginning, in terms of previous performance. And one of the things I have a problem with all alternatives is the lagging on reporting and all this stuff. To me, it makes it a no-go, but that's a fight I lost. So, do we have a history of the AUM reporting from Principal over the last 3 to 15 months? In other words, can we get a picture of how much it's reduced versus what we think the marketplace has done? And that would help I think our
longer term, not, looking at, it's real estate, should be looking at not a year and a year and a half should be going.
No, what I'm saying though is it might, in other words, if the committee and the rest of the group likes the idea, the cherry on top might be that there's a lag in both directions. And that Principal, it may be a good time to make this trade, purely as a trader now, I'm talking about it long-term, because it's possible that over the next X months, we're going to see significant continued declines, simply reflecting what's really happening in real estate out there on a big lag because of the way these funds operate, right? They don't sell things and they have to price them themselves and there's a lot of conflicts and we don't need to get to that. So sometimes it can work for you as well as against you.
It may not be a bad idea too to educate the board because the purpose of this is not to generate more alpha. The purpose of this is to reduce vol, right?
Yeah.
So bringing a correlation table, I think may help also because that's the real motivation of why we're doing this. We're trying to divest from real estate to lower volatility, not to generate returns. So that may be helpful if you can show some historic correlation data. That may help the board be able to spoon feed it a little bit.
So is it fair here? There's interest in exploring keeping real estate, but ask the group's thoughts on introducing other fixed income assets as part of option B.
So that was a alpha generated decision, right? That was to generate more alpha. Or that was also for justification.
The portfolio allocations of here, the non-alternatives, all passive. They're
Okay, so
certainly
I would like to know a whole lot more about the kind of the emerging market debt hard currency allocation that you would recommend. I spent most of my career here in emerging markets, and I'm pretty uncomfortable with that as a straight up allocation, particularly with the M2 money supply in China data that just came out, and not knowing how the allocation of emerging markets will be and the overweight of China probably likely to that portfolio. So I would want to understand a whole lot about that before kind of embracing that, even as a concept.
I'll second that just as a statement. Just in other words, more information.
Definitely do that. I have a question for the group before I do, maybe other comments or questions or viewpoints on what Josh has walked through.
Well, I want to take a second just to put this all in perspective. We were chased out of Vanguard. We needed to find a new manager. I would approximate that 80% of the reason for hiring BlackRock was to replicate the Vanguard portfolio and asset allocation that we currently had. About 20% was to listen to their recommendations on asset allocation, maybe new asset classes and so on, which means we don't need to take any of these recommendations. We don't have to. 80% of the job has been accomplished once we get comfortable with the vehicles. So this is just their best shot at giving us recommendations. I would say that there's a bit of an irony here in that people want to know what's in the real estate portfolio, what's in the hard currency, but nobody cares what's in the US equity index or the global equity index. I just throw that out as something that I find interesting. But again, we don't need to adjust the asset allocation at all. We have accomplished most of our job by finding a new provider who will replicate what we had.
No, just to revisit a comment I made prior was the current asset allocation as is does accomplish the primary investment objective. We believe it's a slightly higher volatile portfolio, so that leads to potentially more volatility down the road in terms of the contributions the town would owe pension plan, right? You underperform 6.9% return, that increases the unfunded liability, and then that gets amortized. You have a very long amortization period, so some volatility is not going to be immediately recognized. You're not marking to market the portfolio, and so you do have the ability to smooth. But our tendency is to find, can we produce a portfolio and manage a portfolio that should generally achieve the same return and minimize some of that volatility, make some of those contributions a bit more predictable down the road? Is another thing to consider, is 50 or 100 basis point reduction volatility going to be that meaningful? We think over the long run, yes, that over the course of 20 years, you might see a bit lower contributions. Over the course of 3 to 5 years, the impact of contributions will be generally minimal because you smooth assets over 5 years. You amortize unfunded liability over 20 years or 8. I think the amortization period, is 18 now, but you do have this long horizon window. So some downside, you do also potentially benefit from some upside. But in general, as I come back to BlackRock, recommends more diversified portfolios than the current portfolio is. And maybe it's just diversifying from the current fixed income and keeping the alts the same. And maybe that's part of the conversation follow-up.
Just to be clear, option A is the current portfolio. So the model portfolios do include the status quo.
Well, option A, Bill, gets rid of
A
real
is
estate.
not, isn't current
Yeah.
what we have.
Yeah.
Option A is just another option.
The first column.
Oh, I'm sorry, the first column. Sorry, I misspoke.
Yeah,
It's okay.
First column.
That showed no difference. Like if you were to
Right.
choose option A, you would probably prefer to stay in, would be my bet. No change to the portfolios. That's the same element. There's a bit of a risk reduction in the OPEB, keeping it the same. But I would imagine if you do one for the pension, you want to, keep the asset class taxonomy pretty similar between the OPEB and the pension.
One thing about this board, which is, I think, excellent, is that we do try to dig in and at least understand what we're doing before we do it, which probably puts us in the top, say, 5% of funds out there. And so I don't think any of your proposals are bad or good or in between. I just think we need to understand, particularly, I was going to raise the same questions Carolyn did about the high yield and particularly in the hard currency, which I have to learn about. It's an area that I'm particularly.
They're fair questions. And just to echo Barclay, 80% of hiring us because we can execute where you were. But the other 20% was giving options and education to go on that journey down the road. So just because you decide something now doesn't mean we can't talk about it, learn about it, and evolve over time. And that's the fun part in our role. So I don't want to speak for the group, but
I was also going to add, it's not just 80% executing today, but being able to execute all of these portfolios, however this evolves over time. BlackRock can be here to execute whatever the committee feels comfortable with leaning towards. And that might not be anything changing this time, and maybe 3-4 years from now, or 2 years, however long until we revisit this, being able to execute something different.
One of the reasons why a number of the board members chose BlackRock was because of your Aladdin. Can you bring us through slide 17? There's some really good data at the bottom that talks about stress tests.
Sure. So what Aladdin does is it maps assets to various factors that BlackRock has determined are the ways that markets move and correlation factors between them. And we can bucket them very broadly in maybe 7 or 8 broad categories. That's the top of the page. So that's what the top of the page is just showing is the risk exposure that you get from various options. So for example, moving from your current portfolio to option B, for example, you're reducing the risk exposure that you have to equities. Just increasing, it didn't print out on the printed buckets, but the gray bars, you increase moderately a diversification element amongst the asset classes, because you're shifting some of the risk exposure to generate these returns from equities, from core bond, to other risk factors that you might get from emerging market debt, from high yield, from private equity. In terms of being able to shop and do performance stress tests, the bottom of the page has a number of scenarios that we modeled for you. The first one is the global financial crisis. This is year 2008, 2009. The second one is COVID peak to trough. So this is literally just the 30-ish days from the second to last week in February to the second to last week in March, when the S&P went from its peak to its trough. And then the last one is a scenario where we would see an equity rally and rates increase in that regard. So in equity market crises, having a bit more diversification, introducing some of these additional fixed income asset classes, has a moderate reduction in the downside risk of the portfolio. Your current portfolio would fall about 26.4, 26.5%, and option B would fall just 25%. So you'd save a little bit on the downside. That's the volatility reduction element of moving from your current portfolio B, having that risk reduction, some of the downside risk in an extreme scenario like the global financial crisis. In a COVID peak to trough, the portfolios end up looking about the same, and part of that is just driven from some of the exposure that you have in more of the emerging market and the high yield exposure not being as diversifying during COVID as it was during the global financial crisis. On the flip side, because you've reduced some of the risk exposure to equities, certainly in an equity rally and rates come up period, we can think about that being, maybe the last year and a half. The current portfolio would generally outperform a portfolio option B. You've added a little bit of duration, which is part of the diversifying element of portfolio B. You've added a little bit extra duration to the portfolio, which generally is negatively correlated to equities. So when equities rally, you have a little bit less equity exposure, so the current portfolio outperforms. And when rates rise, you have a little bit more duration, and so your fixed income assets would not do as well, and therefore portfolio B would underperform this.
So I really appreciate you adding this slide, because this shows exactly why we're suggesting portfolio B, and it really brings it out to the trustee exactly what the impact of, even though it is historical data, but at least it brings context to it.
do you have any thoughts or comments, recommendations?
I really appreciate the engagement on this. A lot of good questions that we will circle back and provide answers to. We'll work a little bit with the subcommittee and on how best to deliver some of those answers. I think sooner rather than later, whether it's, I don't know how everyone would prefer to see some responses, whether that's, a couple slides and a broad email with an explanation, or, whether it's through another meeting.
If I could just run through what I think the next steps are, everybody push back if I'm missing something. So on the CIT side, we're looking for the liquidity impact and the cost impact as well. So why are we doing this basically?
And a deeper dive into the,
The whole structure of it, the mix of it.
And related to the history as well, because this is something actually I wasn't aware of that I think is a serious issue. If we've actually tried to be nimble and agile, which I would normally wouldn't think of us being, normally aren't, but if in extremis, if we want to be, yes, that's one thing. I would have thought coming into this, and I may be a voice in the wilderness on this one, that's not where we want to be. If COVID's coming back or, there's a war breaking out somewhere, we're going to be liquidating, going against our policy decisions, trying to be nimble. I would have thought not. But if in fact we might as a board, since I don't speak for the board, I think that's an issue. So I leave that open, and that's frankly surprising to me. A correlation table, I know we've seen something, whatever you have that you think is most responsive to what you've heard here. The EM debt comment that Carolyn, certainly respect. My recollection of research is that the research shows that active management in EM debt and in high yield is actually those are two of the only areas where I've heard that active management consistently shows alpha.
And I think it's not the only areas of fixed income, but I think Carolyn's question was more of a composition. She does make a point, like it is generally
Right.
sovereign issued debt, but we can get more,
I'm just looking for information, guys.
yeah.
Right. I just for me, it's just a request for a little education around it. Yes, and having a robust discussion around the trade-offs relating to things is what this board is supposed to do, right? And so, Tom, you're right. All the things you're bringing up.
And those are the three things that I have in my notes. I'm sure I've missed things, so I bet you I missed.
no, I think the only question I think going forward is, do we want to, and since I was so vocal on it, I'd like to be part of it. Do we want to create a small group that could interface with you guys on this trust issue? Go back and forth a few times until we're all satisfied, and then bring it to the bigger board, either at the next meeting or even through an email, if we think it's necessary, or do you want to go, to the whole board, which I think is.
Let me just try to,
beneficial.
so there is a subcommittee already. If it makes sense to add at least Ken, Carolyn, if you concur, and anybody else who wants to raise a hand, that to me would be responsive to the question we're being asked. So, Carolyn, do you concur with that? Bill, you concur with that?
I concur, and I think the quicker the better. And I just think it's an understanding of the trade-offs, and just an exploration of it, just so we're sure we're all on the same page.
All right, so let me ask the pointed question. Ken has volunteered to join. Is anybody else interested in joining the subcommittee?
Won't be very sub.
Yeah.
One thing we can offer, Ken, is, so the BlackRock Trust companies who sponsored, we have, I have multiple contacts that I work with there, and we can maybe sponsor a call. The nice thing is they're all based in San Francisco. So.
You offering to fly me out there?
No, but an evening call is.
Oh, okay.
Prime work.
I'm kidding.
Prime
I'd be
work
happy
hours.
to do whatever you guys, you guys are the experts. I don't mean that sarcastically. I'm very confident, and you guys will get us through this. And whatever you think the best way to communicate is fine with
So
me.
it sounds like the four of us will now be the subcommittee, and we'll deal with this early next week, and look forward to being educated.
Look forward to that.
Carol, are you still on the phone?
I am trying to check the family into a hotel. Guys, amazing ability to multitask.
Anybody who says Carolyn doesn't give it 100%, I mean, come on.
Son must hate us.
He loves it.
Yeah,
exactly,
I'm
right.
getting some serious. Oh,
John?
No, he's
you guys wouldn't believe the side eye
Serious engineering.
I'm getting here. No, I think this is excellent. I think it's a good, and let's have you see if you can get questions on that next week. Let's move quickly on that part. And if we want to call another meeting of the JRIB before the next scheduled meeting in October, we can do that too. So I will take the subcommittee's recommendation of when we should get together again to put this in action. And then lastly, I will call principal and see if they will come in and they can present to the board at the October board meeting. And so we can do we can do it side by side.
Excellent.
And it just, Eric, you were around for the pivoting on the policy percentages during COVID and
I was, but I'd like to speak to that just a little bit. Like I look at this as it's a 70-year asset, right? It's a 70-year liability. We're hiring people at 20 years old that we're going to be carrying till they're hopefully 90 years old for retirement. And that's the way I've always treated the pension fund. So if there was going to be any decision that was going to be made to generate cash because we were going to sell out of a position, it wouldn't be a tactical decision. It would be because we need to raise cash for payments.
Right.
Right. And it's not like we're drawing down a large percentage off the trust anyway. We're in a very financially good position. So the decision of having to liquidate within 2 days, are we going to do that tactically? No, we've never done that. You know what I mean? I've never felt that way, that we felt like we had to get out of a position. Did we have other situations where we had, illiquid vehicles that we had to get out of because of other issues? Yes, we had that. But I can't remember, besides having to raise cash or being concerned about raising cash for a payment, did we make tactical decisions?
I agree with you 1,000% on what you're saying. But
You gotta buy back in. At some point, you
But I
gotta
will-
buy back.
No, I agree with you, but I'll also just point out that I've been on this board now a couple of times on and off with Board of Finance in between. I'm not saying we did the right thing, but I forget the fellow's name who was the chairman, John Starr, I think, but we during the 08-09 period, we actually made some immediate decisions that may or may not have been the right thing to do.
Well, that's what I was trying to get to.
Right.
We never went back and did, we call it a whitewash. We never went back and looked at it historically to see if that was a good thing to do.
Yeah, no,
Right? And historically, it's not the best thing to do.
generally.
Again, because this is not my retirement or I'm gonna need it for 20, 25 years. It's a 70-year vehicle. Right? That's the way I've always looked at it. So the noise is just noise.
I think we can drop it on this. It's a great point for the subcommittee to remember because it's not, and now I'm going to argue against my earlier points. It's not necessarily whether one is better than the other. It's whether or not it's better or worse in a way that works for us. And if it turns out that it's, this much worse, but better in other ways, and like Eric said, the chances of blah, blah, blah. So I'm not going into this with a presupposed.
Great. Well, I think the issue is, liquidity impact versus cost impact. And let's think about for us as a pension plan, where do we come out?
Yeah, and defining that liquidity.
A good list.
Yeah.
Thank you.
All right.
Is that it?
You know, done. Motion to adjourn?
Eric Caliper, I'll make a motion to adjourn.
Bruce, thank you.
Thanks, guys.
Thank
you, Carolyn.
Thanks, Carolyn.